The stock market is a roller coaster ride, isn't it? One moment, everything is soaring, and the next, it's plummeting. But what if I told you that these crashes don't have to be the end? In fact, they can be your opportunity to build wealth. The big question is, how do you profit during a recession? The answer lies in understanding the market dynamics, preparing early, and making smart moves when everyone else is panicking. Let's dive into how you can thrive even during the toughest economic times. Understanding the stock market crash. The truth. You need to know recessions are a part of the economic cycle. Market crashes happen, but that doesn't mean it's time to throw in the towel. Over the years, I've seen market crashes come and go, but each time I found a way to come out stronger. Investing during a market crash can be incredibly rewarding, but it requires preparation, patience, and a clear strategy. Let's take a closer look at how the market works and how you can position yourself to profit. The 3 types of market declines. The first step in preparing for a market crash is understanding the different types of market declines that occur. Market correction. This is the most common type of decline. It occurs when the market drops by at least 10% from its recent highs. Market corrections are often caused by a natural rebalancing of the market. These occur roughly every 1.2 years on average. While they can be unsettling, they usually signal that the market is adjusting rather than experiencing a full-blown crisis. Bear market. A bear market happens when the market falls by 20% or more. These declines last longer, often for several months, but they are also more predictable. On average, bear markets occur every 4 to 5 years, and they last around 9.6 months. Bear markets offer unique opportunities for long-term investors to buy at discounted prices. Stock market collapse. A collapse is a drastic decline, often exceeding 30%, that happens over a short period of time. While these are less common, they can occur during times of extreme economic distress, such as during financial crises. The most severe market crashes are rare, but understanding how to navigate them is crucial. How to predict a market crash. Predicting the exact timing of a market crash is impossible. However, there are signs and patterns that can help you prepare. A market crash typically happens in 3 distinct phases. Number 1, the Euphoria Phase. The Euphoria Phase is often characterized by an overwhelming sense of optimism and excitement in the markets. During this stage, asset prices are rising rapidly, and investors are filled with an infectious sense of confidence. The fear of missing out, FOMO, drives many to buy into trends, sometimes without fully understanding the risks involved. Positive news and high-profile successes amplify the belief that the market will only continue to go up, causing many to ignore underlying warning signs. At its peak, the euphoria phase can result in inflated valuations and speculative bubbles. Investors may overlook critical fundamentals, chasing quick gains instead of evaluating long-term potential. This phase is fueled by a sense of certainty, with many believing that the market will always continue to rise. While it may seem like a time of endless growth, the euphoria phase is often a precursor to an inevitable correction. The combination of overly optimistic sentiment and unsustainable valuations creates the perfect environment for a downturn. Still, for those who recognize the signs, the euphoria phase presents a critical opportunity to reassess investments and brace for what's to come. Number 2, the reckoning phase. The reckoning phase is one of the most challenging stages in any market cycle. It occurs after a period of excessive optimism or overvaluation, where reality begins to set in, and investors are forced to confront the true state of affairs. During this phase, the market undergoes significant correction, often marked by sharp declines in asset prices, a reduction in consumer confidence, and widespread uncertainty. For many investors, this phase can be emotionally taxing as portfolios lose value and the long-term outlook becomes unclear. However, the reckoning phase is also a time of necessary recalibration. It's when weak investments and speculative bubbles are exposed, leading to a purge of unsustainable businesses or trends. While it may seem grim, this phase is essential for resetting the market and establishing a more stable foundation for the future. For investors, it's important to remain focused and disciplined during this phase. Opportunities may arise for those with patience, as undervalued assets or quality companies emerge stronger and more resilient for the long term. Number 3, the recovery phase. The recovery phase is a critical part of any market cycle. After a downturn or financial crisis, this phase represents the time when the economy, markets, or specific assets start to bounce back. It's characterized by increasing confidence, improved economic indicators, and growing market stability. During this phase, prices of stocks, real estate, or other investments gradually rise as demand returns and sentiment shifts from negative to positive. For investors, the recovery phase can present significant opportunities. It's a time when market fundamentals start to reassert themselves, and undervalued assets from the previous downturn often show strong growth potential. However, it's important to be cautious. Not all assets or sectors will recover at the same pace, so it's essential to focus on quality investments with strong growth potential. Investors who strategically enter during the recovery phase can reap substantial long-term rewards as markets stabilize and ultimately thrive. Patience and careful observation are key to navigating this phase effectively. Diversification, the key to weathering the storm. Diversification is one of the most powerful tools in an investor's arsenal, especially when navigating a market downturn. By spreading your investments across different sectors, asset classes, and regions, you reduce the risk of your entire portfolio taking a massive hit if one area falters. It's like not putting all your eggs in one basket. If one basket falls, you still have others intact. During a recession or market crash, some sectors might suffer, while others may thrive. For instance, tech stocks could plummet, but healthcare or consumer staples might remain steady. This strategy ensures that no matter what happens, you're not overly exposed to one particular market sector. Diversifying also means having a mix of stocks, bonds, and even cash, which can provide stability when the market is volatile. Ultimately, diversification helps you withstand market storms and gives your portfolio better long-term growth potential. Take advantage of lower prices. When markets dip or prices fall, it can feel uncomfortable, but it also presents a golden opportunity for investors. Lower prices mean you can buy assets at a discount, whether it's stocks, real estate, or other investments. By purchasing when prices are down, you position yourself for potential future gains as the market recovers. However, it's essential to do your research and focus on high-quality assets with strong long-term prospects. Timing the market perfectly is difficult, but buying at lower prices gives you the chance to benefit when the market rebounds, leading to greater returns in the future. The mental game: how to keep your cool. During a crash. The emotional aspect of investing during a market crash is just as important as the financial strategies. It's easy to get swept up in fear and panic, but remember, history shows that markets always recover in the long run. The key to surviving and profiting is to stay calm and stick to your plan. Investing during a recession requires mental toughness. You need to be prepared to hold on to your investments even when it feels like the world is falling apart. Be patient and understand that market crashes are a natural part of the cycle. Your long-term success will depend on how well you navigate the storm. Recessions may seem daunting, but with the right strategies, they can be a time of opportunity. By staying informed, diversifying your investments, and maintaining a calm approach, you can not only survive but thrive through a market crash. Prepare now and profit later. If you found this guide helpful, don't forget to like, share, and subscribe to our channel Financial Success Hub for more tips and tricks. Thanks for watching, and until next time, happy investing.